Hello, and welcome to the first quarterly review and market outlook. My name is Austin Fitch, and you're here with Horizon Investments. We're joined today by our Chief Investment Officer, Scott Ladner. Really excited to dive into the conversation, looking at a recap of 2024 and what we're seeing as we dive into 2025. I really appreciate everybody taking the time today to just spend a few minutes with us. If you haven't been with us in the past, we do these every quarter. We really try to dive into what our investment management team is seeing, how that's affecting their views on markets, product positioning, those types of things. We'll talk a lot about that today and really get into a number of details when it comes to the markets and the economy. So with that being said, we will dive into what we're seeing from a market standpoint. You'll see really three high-level topics that we're going to touch on. But once we start to unpack those, you'll see there's a lot of stuff that really fills into the economy, the consumer, and the markets from that standpoint. So without any further ado, we will jump in. And the first thing we're going to talk about today actually is something that we've talked quite a bit about really over the last year. And that's this AI revolution that we've been really harping on for quite some time. And Scott, we're going to kick it off with this AI conversation like we have for a couple quarters now, because we think that is something that's really going to be super impactful from a market and economy standpoint for probably the foreseeable future. So Scott, tell us what we're looking at. Tell us kind of who Jeffrey Hinton is and what this quote really means.
Yeah, and thanks, Austin, and hi, everybody. Look, we have kicked off these for, I think, 6 quarters in a row now with something having to do with AI. It should kind of clue you in as like how important we think this is. This is the next kind of PC internet revolution. We're in the middle of it, like probably still pretty early stages because people are still trying to figure out how to use it. But I did see this quote from Jeffrey Hinton, and Jeffrey Hinton, the shorthand of it is like he's generally thought of as sort of the godfather of AI. And I thought this comparison was apt, and fairly interesting, so I threw it up there. He's really comparing the what's going on with AI right now to the last industrial revolution that we had. And so, if you think about what happened with the industrial revolution, is the first time that humans made machines that were stronger than them. And then that encouraged and enabled all sorts of different types of work and productivity enhancements and everything else. Machines can do more lifting and more stuff than humans can, or than an ox can, or anything else like that. And he said, listen, think about AI as sort of another industrial revolution, but instead of, for the first time, humans making things that are stronger than they are, we're going to be making machines that are smarter than us. And think about what types of work and what types of productivity that may be able to unleash if we're able to make machines for the first time that are actually smarter than us and can solve problems that humans can't solve today, or at least solve in any sort of reasonable amount of time. And so, just that framework, I think, was pretty interesting to me, and I thought fairly useful. And so I just wanted to kind of just share with you guys as just one more thing. Like, this is a big deal. Get AI, like, figure it out, use it. It is the next big thing. It is still happening. And if you're not on board with it, you're going to be behind. So please don't be behind.
Well, and Scott, something that we've talked about a little bit in the past, and I think we want to make sure that we expand on it today, is it's not just the technology itself, it's what the technology actually brings to bear, and that's that productivity conversation. So maybe walk us through these two charts and really what we're seeing and maybe what we should expect to see from a productivity standpoint.
Yeah, look, when we're talking about, we're markets people. So when we're talking about markets, at the end of the day, AI, this stuff's really cool. It's fun to play with. It's really interesting. And can do all sorts of neat stuff. But at the end of the day, it's got to matter. It's got to matter in terms of like worker productivity. It's got to matter in terms of earnings and all these types of things. And that's the way that AI feeds through into markets, to be clear. And just through the productivity channel. And so what we've seen is, like, we had kind of a productivity lull, productivity growth lull in the United States and around the world, really from around the great financial crisis up until really recently, kind of Cody situation and AI situation. And what we're seeing is, like, we're just seeing an inflection higher. And if you look, have a little bit more longer look at history with the right chart, these things do tend to go in sort of cycles. And we've been at sort of the bottom of the cycle in terms of productivity growth in the United States. Look, and be clear, if you're not getting productivity growth in the United States, you're not getting anywhere else. Like, this is the productivity growth hub of the world. And so in the end, it is important to understand that. But if we are in this sort of first upswing of a next sort of kind of generational change in labor productivity, that just means being able to do more with less. And if you remember your macroeconomics, and like what you can pay people is based on what they can produce. And so if you can, if you can produce more as a human using AI, you can get paid more. And if you get paid more, living standards go up and all other sorts of virtuous things happen. And so understanding the productivity side of things ends up being a really important component to understanding sort of the potential growth rate of an economy, the potential earning stream for its citizens.
Yeah, and Scott, I think it's important maybe even to translate it a step further is if we start to look at profitability, how does that tie into productivity? I think what's really interesting is if you think about kind of the last two times where we really saw kind of those productivity booms, think of it as kind of the mid to late 90s. You saw a productivity boom. You technically saw a productivity boom right in the early 2000s. Some of that turned out to be financial engineering, which we all know kind of how that turned out. But I think it's worth at least looking at the fact that when you get productivity booms, what does that do to profitability? You can see it there on the left-hand side. And Scott, you talked about the fact that we really haven't seen giant, jumps in productivity over the last 10 to 15 years at this point. You kind of see that on the right-hand side of this chart. You've seen profitability somewhat stagnant over the last 10 to 15 years. So I think the question is, from a market standpoint, is if we do get that productivity boom, does that take us a leg higher from a profitability standpoint? Is that something that maybe positively impacts markets? And I think, is it fair to say that's something that we're watching pretty closely as we head not just into 2025, but into the next couple of years?
It is the tailwind which will keep going. It is an underappreciated tailwind towards corporate profits, and as profits go, so go the markets.
Yep. And I would say this, I would encourage anybody who's not even just kind of dabbling in AI to start to really kind of figure out what's out there. We've had a number of conversations with advisors that are figuring out where they can use it to drive efficiency and productivity gains in their business. So we'd be happy to have those conversations as well, just to idea share, because that's something that, again, as we talk about, you're trying to figure out how to make your business more productive, more efficient. Like, there are ways to do that. Scott, we're doing it internally here at Horizon from a research standpoint. Maybe share just briefly how we're using some AI, so folks get a sense of it's not making investment decisions, but we're using it from a research capability to make things a lot more efficient.
Yeah, certainly. I mean, look, we use it to help code. It helps speed up projects. We were using it to help digest massive amounts of data. So they think about an earnings transcript bot that you can just feed in all their earnings transcripts from all the companies and then ask it questions. So it's got 10,000 pages worth of earnings transcripts, and you can basically go in queries like, how does what are companies saying about China, or saying about Trump, or saying about the consumer, or whatever. Just start asking it questions. Those types of things would typically take sort of a team of analysts. And now we've got it in really at your fingertips whenever you want it.
Yeah. No, great point. So again, just wanted to hit that off the top because that is something that we think is extremely important as we head into the next couple of years. But maybe changing gears a little bit, and this is something that I know we've talked a little bit about for the past couple quarters, is this idea of confidence, right? And the fact that you've really had confidence that has, I would say, for better or worse, been below where we would otherwise have expected it to be for quite some time now. And you're finally, Scott, seeing that start to transition where folks think maybe confidence, from a confidence standpoint, they think that business conditions maybe start to get better on a go-forward basis. So maybe let's unpack that a little bit. Why is that important? Why is that relevant from a market standpoint? And then how do we think that plays out market-wise?
Yeah, look, I mean, this chart goes back to 1993. I mean, it's pretty clear that U.S. businesses. So just to be clear, so when it's a dark blue line, when it's dark blue kind of shade area, that means that the companies think that the business conditions are going to be better in 6 months. And when you see that light blue, when it's kind of below zero, that means that companies think that business conditions are going to get worse over the next 6 months. And so this is a picture of American optimism. Like in some respect, I mean, people generally think that things are going to get better. Which is a helpful thing, but not always. And so the unusual part about the last few years is, one, the length of time through which we've gone through this like kind of modestly negative business sentiment environment. People think things are going to get worse for a while. That certainly has to do with something with inflation and everything else. But that played through. And the reason why these things can tend to matter. And by the way, so clearly we've kind of turned the corner on that, and people now think things are going to get better again. But part of the reason why this matters is this can impact hiring plans. It can impact plans to expand, impact CapEx. It impacts things. If you don't think you're going to grow, or if you don't think things are going to get better, you're less likely to take risk. You're less likely to do things that are expansionary. You're less likely to do things that are helpful from a figuring new stuff out. You get to go back in your trenches and sort of hunker down and kind of try to survive the times. And that's not terribly good for growth in general. I mean, it's like fairly obvious to say, but important to say. And so as we're coming into this kind of more expansionary time, people are feeling better about their businesses, like on a future look basis. That we think it's really, look, it's tough to measure. But in terms of just sort of like the backdrop towards expansionary types of business activities, we think this is probably a helpful tailwind.
So Scott, that kind of feeds into this next conversation that we're going to have, and I think part of the reason maybe that folks felt as bad as they did, or had maybe more of a pessimistic outlook, was that hiking campaign that the Fed undertook for the last couple years, right? Finished up last year, and I think what we've seen actually is this realization that maybe there wasn't as much of an impact as you otherwise would have thought from a corporate or a business standpoint when it came to that hiking campaign, which has begged the question and kind of hints the title of this slide, like, why didn't this have a bigger impact? And I think we've wrestled with that for a little while, but it really comes down to the fact that if you think about corporate treasurers, if you think about CFOs of many of these companies, they're not dumb people, right? They're actually probably really good at their jobs, generally speaking, especially as you start to look at a number of the maybe more sophisticated companies out there. And what I mean by that is they took advantage of the fact that when rates were low, they locked in those rates for a long period of time. Why is that relevant? Well, if you've locked in low rates, a hiking cycle doesn't have nearly the impact that you would otherwise expect it to see. So you can see there in both of these charts, whether it's the chart on the left looking at net interest as a percentage of debt, the right just looks at net interest payments. Both of those, as we headed into the 2020s and the first couple years of the 2020s, really were at, almost think of it as all-time lows. And that's extremely impactful and extremely important as we're having this conversation about a hiking campaign. Now, we'll talk in a slide or two that it doesn't apply equally to all companies, but that is something that we want to make sure we highlight on the front end is corporate treasurers, CFOs did a really good job in terms of managing kind of those interest payments because of what they did coming out of the great financial crisis, taking leverage off the balance sheet, locking in, like I said, locking in those low interest rates. So that's something that we wanted to highlight on the front end. But Scott, I think it's also important to look at the type of economy that we had, because it's very different today than maybe what we would otherwise think of, call it, 30, 40, 50 years ago. And maybe tell us like why that matters as we start to think about the impact.
Yeah, I mean, this I think is somewhat of a forgotten point sometimes. It has been a very important and helpful exercise to undergo for the last few years to figure out, like, to what extent do the Fed's interest rate activities impact the economy, through what channels, and like how's it work? And the point of this chart I want to put up here was, like, it works differently than it used to. Look, when all the people at the Fed were getting their education, when they're getting their PhDs in the 70s, 80s, and 90s, they had they got their education in a time through which the U.S. was much more of a manufacturing-based economy than a service-based economy. And so the way that that interest rates impact a manufacturing economy or a manufacturing firm versus a services firm, think Caterpillar versus Google, is it's just different. I mean, like, if you have an inventory cycle, then rates matter. Then you have to do forecasting of economic conditions, and you got to do inventory management and supply chain management, all that kind of fun stuff. If you're Google, you really care? Like, no. I mean, there's no inventory for Google. There's no sort of managing around interest rates, and so that the point of this is just to kind of keep in the back of your head as you're thinking through these problems, like understanding the why. It can shed a lot of light, and can probably help you have good conversations with your clients about, like, why was this time different? Because it has been, and we've talked about that a bunch. But one of the primary, just sort of fundamental reasons why it's been different is because we have a different economy. We have a services-based economy. It's the 70 to 75% of the economy is service-based. Far more than that in terms of employment. And so just reminding yourself of this, like, we don't have a goods manufacturing-based economy anymore. We're never going to have one again. It's like that day is past. And so the way that interest rate changes impact a service-based economy versus, which is not very interest rate sensitive, not totally insensitive, but not very interest rate sensitive, relative to a manufacturing based economy that has inventory cycles and everything else, it's a far different picture. And so, one large sort of fundamental reason why the Fed rate cuts haven't had the impact that many people thought they might is just because of this fact. Like, it's a different type of economy, guys.
No, that's a great point, Scott. I think you said something too that we'll kind of expand on here in just a second, is this idea that it also affected, companies differently. Like it didn't affect every company equally. And I think one place where that becomes very clear is to look at, larger companies relative to smaller, small and mid cap companies, especially as we go back to that idea of kind of interest expense, right? And I think what you see there is that maybe larger cap companies benefit a little bit more from the ability to lock in low rates for long periods of time. Maybe they don't have nearly as much variable debt as opposed to fixed debt. And I think that's something, Scott, that really became, I would say, exceedingly clear as we went through 2024 and really even the couple of years before that, and what that meant from a corporate balance sheet standpoint. So maybe let's pause for a second and let's explain maybe these two charts, but also like, why is that important? What does that mean for 2025 as we're looking forward?
Yeah, I mean, look, the chart on the right probably tells a lot of the story. It's the chart on the right is saying how much of your total debt is is fixed rate versus variable rate. And for the big companies, for SP 500 companies, 80% of their debt is fixed rate. So like, doesn't really matter what Fed does. At some point you got to refinance and everything, but it doesn't really matter for short-term operations. Like what the Fed does, if 80% of your debt is fixed rate. For small cap companies, for smaller companies, that's half. Half their debt is variable, half their debt is fixed. And so when the Fed hiked rates, that's why you get the results that you do on the left. Like for large companies, especially ones with large cash balances, they're getting paid 5% on those cash balances, as everybody knows. Their net interest actually went down through the Fed hiking cycle, a fairly material number, $162 billion. Whereas small cap companies had half their debt is floating rate, and they don't have as much cash balances, so they're not earning that 5% on all that excess cash. They did have a higher interest expense, and it did sort of work like the model would think that it works. The small cap companies have been far more exposed to higher interest rates that the Fed has engineered than large cap companies have been. And so, but when you think about the economy overall, the economy overall is dominated by the larger companies in terms of economic growth, output, and everything. And so, while employment is dominated by small cap companies, output is dominated by large caps. And so, this is part of the reason why the economy has actually been able to sort of shrug off a lot of this stuff is because of, because that's those size differences and sort of the makeup difference of the debt profiles. But, just understanding it hasn't impacted everybody equally. Large cap companies have benefited, small cap companies have gotten hurt. And so the reverse is going to end up being true as Fed continues to lower rates throughout the next year or so.
Yep. No, and Scott, if we're talking about maybe even just the differences between kind of those two different segments of the market, I think it's important maybe to also take a look at a few other kind of differences that you see between those two segments. And I think it's really important, right? Maybe to ever so slightly dip our toe into the political side of things. Again, not putting a hat on either side of the aisle, but just looking at the data and the facts here. And I think what we see is that regulatory costs maybe also have a varying impact as you start to think about firm size.
Yeah, and look, I mean, again, these are just the facts. I mean, the Biden administration was very heavy-handed on the regulatory front. Those regulations end up costing a lot of money. And that's left right. I don't think we're saying anything that's sort of unknown, but just calling out this has been a high cost regulatory environment to operate in from a business. That was not the case with Trump 1. We don't anticipate it's going to be the case with Trump 2. We think Trump 2 is going to look a lot like Trump 1 from the regulatory standpoint. So very little cost in terms of regulation going forward. But the cost is one thing, but who bears it? Who bears it is on the right, and people that the companies that are most impacted, the most by higher regulatory costs, are kind of those small mid cap companies. Companies with in the neighborhood of 500 workers. So not 5,000 workers, and frankly not not 5 or 10 workers. They don't matter as much either in terms of regulatory cost burden. But that, those mid-sized companies, like the cost is high. They're not quite big enough to pay for an army of lawyers to take care of it and do everything for them. And so like that's part of why the burden is calculated as being rather high. So not only have they had a high cost, kind of a high cost regulatory environment, but the firms bearing that are more of those small mid type of companies. We do again expect that to be reversed, in the coming 4 years. But that's been the environment.
Yep. Well, and you talk about burdens. I think another one that we got to at least touch on is this idea of a tax burden. And I think this chart pretty simply outlines the fact, again, that maybe the burden that falls on those smaller cap companies, in this case, the lighter green bars, look at the Russell 2000, the darker green bars, look at the S&P 500. I think what it tells us is that burden tends to fall a little bit more on the smaller cap companies relative to the larger cap companies. Now, I think what we're going to say here is we're not telling you that taxes are necessarily going down with the new administration that'll take effect here in a couple weeks. That being said, we also don't necessarily think that taxes are going to go up, all things considered. Obviously, there's still a lot of uncertainty as to how things play out. But our view there is if you get any sort of tax kind of offloading or the benefits maybe of lowering taxes, you would see that more on those smaller cap companies than you would likely see it from an effective tax rate on the larger cap companies, just because of the starting place that you currently see with those two segments of the marketplace. So again, wanted to highlight some of the differences that you see between small and large cap companies. We'll talk a little bit more as we keep going as to maybe why that's important as we get into 2025. But Scott, the last thing, if we're talking about the economy, we can't forget about the labor market. And I think what we've seen is you start to get questions a little bit more recently is, hey, should we start to get worried about the labor market? And I think that's fair given what we've seen from a softening standpoint. But maybe let's look at this data and look at this chart and maybe make the case as to why we shouldn't be terribly concerned, even though it has gotten a little bit worse over the last couple of years.
Yeah, I mean, look, this is, when you talk about the labor market, it's hard to know what you're talking about. There's 15 or 20 different metrics you could look at in order to describe the labor market, anything from participation rates to wages to employment statistics, all this kind of stuff. At the end of the day, like they're all kind of telling you the same thing. And so this, the Kansas City Fed has this monitor that we put up here is sort of like a kind of a catch-all. Like in general, if we're talking about the labor market writ large with all those different types of kind of statistics about it, like what are we talking about here? How's the labor market generally doing? And it's generally doing, as you can see, pretty like right here, like pretty darn good. Now it is softening, but it's softening from a place that was like historically incredibly strong and probably too strong. The Fed highlighted that, that strong of a labor market was really igniting wage gains. Again, the wage price spiral stuff, which were not very helpful. And so like coming off that peak strength is probably a good thing. Settling in right around here and like figuring out whether we're going to settle or where we're going to continue to decline is really sort of the key for at least the first half of 2025. We think we're sort of settling in around where we are here. We don't see any signs of layoffs. We're not seeing signs of massive hiring. Not seeing layoffs either. And wages have basically normalized to basically pre-COVID levels. So like we think we're sort of settling into a pretty nice place in the labor market. This would tend to suggest that's also the case. But as always, we're gonna monitor to see if those theses turn out to be correct. But overall, just think about this labor market is softening from a place of extreme strength. But still pretty strong overall.
And Scott, if we're talking about the labor market, I think kind of the easiest transition would be then to the consumer and what that means in terms of employment, what that means in terms of their strength. But I think what's really interesting is, and we'll talk a little bit more about inflation as we keep going, is this idea of a difference between kind of how folks feel and what the data would suggest. And this chart maybe paints a really stark picture of kind of that difference. And I think we've talked about this for a couple quarters now, is this idea that, yes, inflation, both headline and look at a number of the underlying kind of component parts, inflation is coming down, right? That's the black line on this chart. That is inflation expectations on a 12-month forward-looking basis, right? You can see it really over the last over 2 years at this point has been coming down. What's really interesting, though, is the red dotted line. And that's this idea that consumers don't necessarily feel like inflation is coming down. They actually feel like high prices is continuing to put stress on their individual kind of personal financial situation. So I think this disconnect is what we've been struggling with as an economy. That's that overhang that we've all been feeling. I know we've talked with a number of advisors who are having conversations with their clients about just kind of this feeling of higher prices, this feeling of inflation that doesn't line up necessarily with the black line that you see on this chart. So I think that's really interesting and something that we want to make sure that we highlight is that disconnect or that difference. Scott, I'll let you take this next slide because I'm afraid folks may even be throwing things at the screen when we say it, but it's this idea that, again, inflation has gotten better. Folks are actually maybe even in a better spot today than they've been in quite some time as you start to actually unpack that inflation picture.
Yeah, I mean, like I kind of like these types of statistics. I mean, in terms of like, hey, let's put things in real world terms, like a basket of groceries, and we'll keep it constant through time, and we'll figure out, like, you know, how many hours we have to work in order to pay for that basket of groceries. And clearly, you know, that went up through with the inflationary period that we had in 22 primarily, but it's coming back down. Like, we're not quite at as sort of wage adjusted cheap as we were right before the pandemic hit, but it's gotten a lot better. Now, nobody, like, you say this, people, like, nobody's gonna believe you. Like nobody believes. I say this, but nobody believes me. Like, it's okay. But it is like, they are the facts. Like this, this has happened. People's wages, and we're talking about wages here in a minute, like it's actually outpaced inflation overall. But nobody wants to hear it. Nobody wants to believe it. But it is, this has happened. I mean, like, groceries are much more affordable relative to people's income than they were at the peak. But again, like alluding to that last chart, like, nobody seems to believe yet. But just know, like, these are in the numbers, and eventually time will heal this. People will start feeling better.
And Scott, you talk about kind of it being in the numbers. I think these two charts are great examples of kind of the numbers supporting this idea that the consumer, the end investor that many advisors are working with, from a personal kind of balance sheet, personal income statement standpoint, actually aren't in a terrible spot, right? The chart on the left looks at credit as a share of income, right? You can see we're back to basically where we were coming into COVID there in 2020. You see it's plateaued coming out of COVID. We didn't continue that trajectory kind of past where we otherwise were. Obviously, you can also see the great deleveraging that happened post 2008. So that, again, paints that picture, even if consumers don't necessarily feel it. I think what's really interesting is the chart on the right. And I think it kind of highlights that disconnect, right? The blue bars kind of there in the background, that's the total debt balance across the United States. And I think what's interesting, right, is pick your news channel, pick your media outlet, pick your newspaper. Like, these are the blue bars are what make really good headlines, right? Total debt is at all-time highs. Total debt continues to climb. Like, those are things that will get eyeballs to continue to watch. The red line, to Scott's point earlier, is if you adjust it for income, it actually looks a little bit better than it has really at any point over the last, call it 10 to 15 years, outside of kind of that COVID blip where data got a little bit wonky, but you're actually seeing it come back down. And it's definitely not getting worse. So I think what's interesting is, and we use the title, "Don't Let the Facts Get in the Way of a Good Story," is a number of folks will follow, like I said, doesn't matter which side of the aisle, which channel you're watching, where you're getting that data. The red line is not a good headline in terms of getting eyeballs to continue to follow, to come back tomorrow. The blue line, you're going to come back, you're going to look, you're going to want more data because they're telling you that things are getting worse and worse and worse, and you got to figure out, when are things going to get better. What we're telling you is the red line on this chart, the green line on the chart on the left, actually suggests things aren't necessarily as bad. They may actually be getting better than a lot of folks realize. So I think that's super important to understand. To Scott's point, it may not jive with how they feel quite yet, but we do think the data is there. It's just a question of when the consumer starts to feel it. And Scott, you touched on this earlier, and I'll let you kind of really give us the detail behind this slide. But if you actually look at income relative to inflation over the last few years, like, things are actually better.
Yeah, and look, we showed a chart similar to this, like last quarter, talking about different income quartiles, and so like people at the top end of the income spectrum versus the bottom end of the income spectrum. This is obviously like just looking at the entire income spectrum, but the story remains the same. Like everybody's gained, like everybody's making more money inflation adjusted now than they were pre-COVID. Again, nobody believes it, but it is objectively undeniable. So like these are the numbers, and so like what this chart is looking at different. So you can measure income in different ways. Okay, so hey Scott, I don't believe you. Like you're full of it. Like poor people are worse off than they were. Blah blah blah, whatever. Like okay, let's measure it every different way you can measure income. We can look at average hourly earnings, ECI, which is employment cost index, median weekly earnings, or something called total compensation. I could probably pull more of them if I wanted. They're all, the point is they're gonna tell you the same story. And the story is like let's take all these different measures of income and adjust them for inflation. Okay, but which measure of inflation, Scott? Are you use CPI or PCE or something the government made up or whatever? Like no, we'll just use the two basic government ones and like. But I'll tell you, if you use something like Trueflation or anything else, like it's going to end up being the same stories. Also, let's compare it to right before COVID hit, Q4 2019 till Q4 2024. How do folks do? After taking their income and adjusting it downward for the realized inflation that we actually got, and the total compensation, which is sort of the most holistic way to look at somebody's total comp, because it includes benefits and other things like this. That shows like whether you adjust by CPI or PCE, like people are better off. And so why this is important is because people, consumers are 70% of the economy, as we all know, but you can spend money one or two ways. You can spend based on your income, you can spend out of your assets. Like income wise, we're in good shape here, and objectively pretty good shape. We're gonna take a look at assets here in a minute, but I'll spoiler alert it. It's pretty good too.
No, Scott, I mean, I think it's extremely important that we unpack that. Now, I will say this, I'm glad that you got to cover this slide and the one a couple slides ago, because like you said, people may throw things at you. But I do think it's important.
Happen again. It's all right.
I think it's important to realize, hey, here's what the data is saying. Again, it differs from how people feel, but at the end of the day, the data, it's just numbers. Like there's no emotion tied to it. It's really looking at, hey, how are folks acting? Like what does the data tell us? The data tells us that things actually may be a little bit better than we expect, but also than maybe even we were coming into COVID at this point almost 5 years ago. So Scott, you talked about assets and we've touched on this. I think it was last quarter, is this idea of just the amount of money that has kind of ballooned in the money market space and the checking account space. Like you've seen so much money kind of be dumped in to those types of accounts. I think the question is, at what point does that money start to leave those accounts and maybe go back into the economy, back into the markets? Maybe tell us what we're looking at and maybe what we're looking for as we start to think about kind of that dry powder, as we're calling it.
Yeah, so the green line is money in money market accounts. So people's money that they're stashing in money market accounts or in cash. But blue line is Fed funds as a proxy for what you're getting paid on that cash. And so what we noticed out of this is like somewhere like after a few months after rates had a 3 handle on it, after you get paid more than 3% on your cash, like money started really flowing into money market accounts. And I don't know if it was just like psychological thing or if it was people just like trying to get defensive or whatever it was, but like a few months after we got a 3 handle on rates, money started really flowing in. And then you can see it has not started flowing out yet. So and we got an extra $2.5–3 trillion of money market that's sort of like extra. That money's probably in play at some point to come back into equities or back into investments, broadly speaking. It's just a matter of like at what rate level, like as rates continue to drop, if at least short rates continue to drop. At what rate level does that get people off their bottoms and sort of back in the market again? Maybe when rates have a 3 handle on it again or something like that. And so that but at some point, like this is dry powder. These are assets. So you can spend your income or you can spend your assets. Income wise, we're fine. This is one of the assets that we got a lot of extra dry powder for people to spend. If things get dicey or if they just want to get back invested again.
Scott, you talk about spending assets. There's another asset that I would tell you, right, we haven't talked about in at this point seems like forever. And that's home equity or the amount of money that's maybe kind of built up in real estate and personal real estate. And you're finally seeing, right, this is a chart from Fred that's showing us that home equity lines of credit are finally starting to kind of grow again, right? And I think what's incredibly important, and we'll look at it here in a second, is what kind of liquidity that starts to unlock for the consumer. Maybe help us understand why that's important, and then we'll talk on the next slide, I think, about maybe how much money really is in play there.
Yeah, I mean, look, home equity lines of credit are just liquefying an asset. It's it's a way to take an illiquid asset and make it liquid in some capacity. And so I'm not saying that they're the best thing in the universe, but people have drawn down. Like home equity lines of credit have been drying up for 15 years, 14, 13, 14 years, and they're finally starting to turn around again. So this is showing that people are willing to, even with rates where they are right now, they're willing to tap into and liquefy this otherwise illiquid asset that they've got in order to to increase spending or do whatever they want to do.
Yeah. And Scott, like I said, we'll look at this chart, which then tells us, and there's a lot of money if you start to think about homeowners equity that's built up. I mean, we're looking at 30 years of data, but even if you just look at over the last 5 years and maybe even compare it to the trend that we had seen coming out of 2008, like you probably even have more equity from a personal real estate standpoint than you otherwise would have expected, even just looking at kind of the teens. As you kind of saw that continue to grow over the last 5 years, you saw an even higher trajectory as you saw homeowners equity really bump up to that $35 trillion level. Now, Scott, to your point, we're not sitting here telling folks that maybe that's the best thing for the economy long term, right? There could be risks to that as you start to think about kind of levering up a little bit, like we all saw in 2007, 2008. But I do think it's important to understand liquidity that may be in play from a market and an economy standpoint. Scott, anything that we're missing as we're talking about that as a spendable asset, to your point?
No, I don't think it's something we're missing. I just think it's something we need to keep in mind. Like in terms of people worry about the fragility of the consumer. They worry about that people are stretched, or people aren't stretched. Like this is like an anti-fragile sort of stat. I mean, like there is a couple $3 trillion worth of money market assets out there. There's an extra $15 trillion of home equity that have been created over the last like 5 years or so since pre-COVID times. Like these are just like things that can buffer. It's not saying that people are gonna go out and spend willy-nilly and do silly things and lever up in a dumb way. Like, but these are buffers. Like this is anti-fragile. Like this is a protection sort of layer for the consumer and therefore for the economy. And not understanding that this stuff is there. Is there to be tapped, is there to be used, and is there like a really important source of safety and stability inside the economy and inside the consumers. I don't think people take appreciation for it, but you should, because everybody's employed that wants a job. Everybody's getting raises above inflation, and their assets are booming. Like this is a safe economy right now. I'm saying you can't get something dumb, but the internals of this economy are incredibly safe right now.
And Scott, I think this last chart in this section really speaks to that, right? It's this idea of net worth for the U.S. household. Like, I mean, just tell us what we're looking at here, because again, I think what you've seen from household net worth is it's grown and grown and grown just over the last couple of years.
Yeah, and look at this goes back 30, 40 years or whatever it is, and it is this is year over year change in net worth. So it's not a level. It's just like how much is it changing year over year. And what we just experienced in 2024 is like one of the highest growth in net worth for households and that we've seen. And net worth includes stock market, includes bond market, includes like housing, includes like everything that involves assets and liabilities for a household. And so like obviously coming out of COVID, we saw some massive amounts of net worth gains. And we're not there, but it's like this is pretty good. This is about as good as it gets in normal times in terms of like households having their net worth grow. And this is again just another form of safety, and more assets to draw on if you need to. This is a healthy economy.
No, that's a great point, Scott. So if we take all of that we just talked about, the economy, the consumer, now let's transition that into, okay, what does that mean for markets? And Scott, I think it's fair to say we've been pretty optimistic, pretty bullish with a lot of the data that we've talked about so far, but there are definitely some things that we look at and we say, hey, here's a reason to pause, or at least to take a step back and make sure that we're not, out over our skis. Sentiment and positioning are two things that we don't talk a ton about all the time, but these are things that are definitely maybe a little bit stretched where we see them right now. Why is that important? Why do we think that matters?
Look, it tends to put a cap on how well things can go from a market standpoint. When you chart on the left, like everybody expects stocks to rise because everybody's remembering sort of Trump won in 2017 and how good that was. Pardon me. And so that's the more individual investors, and then the one on the right is going to be more fund managers, more professional investors. And in terms of like overweight stocks, overweight stocks, everybody's overweight stocks. And so like this is like from a market internal standpoint and from a short term sort of standpoint, things are relatively stretched from a sentiment and a positioning standpoint like way. And it's not the best. I will be clear, like toward the end of last year, the end of 2024 saw some of this clean up. I mean, like that was part of that was a washout of this. And so like we're better entering here in January than we were in December, I would say, on these metrics. But we're still this is still like not this isn't a great setup. I mean, it's not a great setup for like a massive year. It doesn't necessarily mean things are terrible. But in terms of like a massive year, like this isn't necessarily what you'd want to see from these types of stats.
Scott, another thing that was maybe dropped on us as we talk about December and some of the volatility, the Fed in December maybe gave us a meeting that I don't know that anybody was necessarily expecting, especially as you started to look at what was said during the press conference and as part of the Q&A session. And I think what's interesting is this idea of uncertainty was kind of put back into the market from as we think about what the Fed's path is looking out into 2025. So help us understand when Chair Powell came to the podium a couple weeks ago now, like what he said and what the market took from that. Like what was the impact of that? What should we expect? How should we be worried? What should we take out of that?
Yeah, I mean, like the thing that they really I think it was sort of surprising and we're not gonna talk a lot about the Fed here. Fed is largely out of play at this point, but they still matter on some things. And what they did and what Powell specifically did in this meeting was essentially reemphasize inflation again. So they sort of, and the market has sort of treated it like the inflation thing is done. We don't have to worry about it. Now we have a single mandate Fed again that only cares about employment. And that means importantly that the Fed put, the so-called Fed put, is back. And it means if growth starts to deteriorate, the Fed will cut rates, and like things will be okay. But when inflation is a problem, then the Fed can't necessarily. This is what happened in 2022. If inflation is the big problem, Fed can't cut rates if things go bad. They can, but they won't. And so the fact that they basically reintroduced inflation as an issue, and so this bottom left chart really highlights this, the change from September to December. The committee generally went from thinking in September that the risk to inflation were basically balanced. That's the dotted line. Like everybody thought it was like we're basically there. It's okay. To for some reason in December, like everybody's like, okay, now inflation risks are weighted to the upside. Like what changed? What changed between September and December? We all know one of the big answers to that is there was an election, and so like that like trying to the thought was like, are they trying to get political? Are they trying to like forecast Trump policies for the next administration that have not been announced yet? And are they taking that into account? Are they trying to take that into account in some of these forecasts? Like that kind of uncertainty is not very helpful. And part of the reason why we had a tough December in markets was is that like the market trying to figure out like, is this a Fed that's going to get political on us? Is this a Fed that's going to try to do things like kind of like in anticipation of Trump policies or whatever? Are they seeing things that we're not seeing in terms of inflationary outlooks? But all that said is that reintroducing inflation as a like weighted to the upside in terms of risks does take the Fed put sort of off the table somewhat, and it takes the idea that big chart on the right is like, hey, we don't have a whole lot of cuts more to go. In September, we had, the market was saying we're going to have rates with a 2 handle on it, Fed funds with a 2 something by the end of 25 and certainly by the end of 26. And now we're saying like rates with a 3 handle, like kind of a high 3 handle on them by the time we're done. So maybe another 2 cuts and that's it. Now, not saying these predictions are going to be right, but that's if you ask what's in the price, what's in the market, that's what's in the market right now. There's like 2 more cuts and we're done. I'm not sure that's quite right, but that is where we are. And part of the reason for that is this sort of changing, so the Fed's changing story on what they think the risk to inflation is. And that's something we're going to get a lot more information in January about, but that's, if you want to know why December wasn't great and kind of why things got a little shaky, like this is a big part of it.
Well, and Scott, this is one that I would say blew my mind a little bit as we started to look at the impact of kind of that Fed meeting there in December was this idea that actually the market started to price in the probability looking out to December of 2025 this year that you could potentially get rate hikes in 2025, which again is kind of mind blowing to think about the fact that, like you just said, 2 months ago, 3 months ago, we were talking about how many further cuts do we see to get us to that two handle, low three handle number that we're talking about from a Fed funds rate. Now we're talking about, like you just said, the idea that maybe rate cuts happen once, maybe twice more. And you see that on this chart. The dark blue lines are kind of what the Fed expectations were for the Fed prior to the Fed meeting. The green bars are expectations for where folks expected interest rates to be at the end of 2025 post the Fed meeting. And again, there's a lot going on in this chart. What's important to realize is the blue bars were higher on the left-hand side of that yellow dotted line, meaning that folks expected rates to continue going down. There was a higher probability of rates going lower from where they currently are on the left-hand side. What you've seen is on the right-hand side, those green bars are actually higher, indicating a higher probability of rates either actually staying where they are a year from now or maybe even being slightly higher. Well, like I said, which is kind of crazy to think about. But that is something that if you talk about the uncertainty that's been put into markets, I think that's something that's pretty important to start to wrap your head around is maybe we don't have as many Fed cuts as we initially thought. So, Scott, we've talked a little bit about obviously maybe some concerns, some things we're watching, but I think it's important, right? We can't lose sight of maybe some of the most important drivers, and that's like, let's just look at some of the fundamental data as it comes to companies. So let's talk about what we're seeing there and why that's important as we start to talk about 2025.
Yeah, I mean, let's start with the chart on the right. Like, I get asked a lot, like, what about valuations? Is this an expensive market? And I think to myself, like, that's such a loaded sort of, in my brain, sort of silly question, because we don't have a market. We have the market is made up of a whole bunch of stocks, and these stocks have different characteristics. They have different sector weightings. They have different ways they make money and everything else. And so, like, the chart on the right is like tries to relate like forward PEs to interest rates, and we have a 4.5% or so 10-year right now, and so, like, given that level of interest rates, like, about where's the right sort of PE kind of range. And the star there is what the SP 500 is. You take all those stocks together, and that seems kind of top, a little bit top of the rangey. I'm sorry, the box is the current SP 500 seems kind of top of the rangey. And but that ignores the fact that the top of this market, like the biggest seven, the Mag 7 companies, are priced very, very high, and somewhere in the 30s in terms of forward PEs, but they should be. The reason why they should be is because these charts on the left, because they grow like crazy. This is not Cisco of 1998. This is not like the tech, like internet bubble stuff from the late 90s, early 2000s. Like, these companies make hard money, and they make a lot of it, and they make it repeatedly, and they make it irrespective of economic conditions, and they make it like these are the best companies in the world, unlike the top of the market in the late 90s. So they should be valued really, really high. And so if you take those, you take the valuation of those big, highly valued companies out, you get the start on there, which is like around a 20 PE. Which is, I'm not saying these things are necessarily cheap, but it's not an expensive market. Like, this is just a market it's about right. It's about right for where rates are. It's about right for where kind of growth is. We're not anticipating like big changes in multiples this year. We think the market's going to be driven more by earnings than by changes in multiples this year. But there's plenty of earnings power, and there's plenty of earnings power not only in the Mag 7, but in the rest of this market, as we're going to see later on this year. But my point here is, like, you don't take the market as the SP 500 as the whole thing. Like, you've got to take out those companies and look at them separately that are different, because they are different. So look at the different stuff differently, and then it'll end up making stuff makes a lot more sense. And just say, like, yeah, it seems about right.
Scott, you talk about kind of earnings and margin kind of growth that we would expect to see. I think this slide does a really good job of talking us through why margin growth is that much more important than even just kind of top line revenue growth. So help us understand kind of maybe what we're looking at here, but also kind of that levered benefit of margin gains as opposed to revenue gains.
Yeah, look, I'll be relatively quick with this. Revenue growth gains have a linear impact on earnings per share. margin increases have an exponential increase on EPS. And so, when the reason why this matters is because what is AI going to do? What do productivity enhancements do? Like, they increase margins. Like, yes, they can increase revenue growth. Yes, yes, it should make revenue growth better as well. But the primary sort of channel through which productivity gains are realized in economic results is via margins. And so, if you get margin expansion in this economy, that is an exponentially large increase in EPS, and that is where you can get sort of the power out of the way that AI can actually impact markets, like it can impact stock markets.
No, that's a great point, Scott. And I think that maybe kind of takes us to our last few slides. And you touched on this earlier, kind of expectations for 2025. And I think it's fair to say that we don't necessarily expect a crazy year to the upside. But it's also not fair to say just because 2024 was a good year that 2025 has to be a bad year. History would and data would actually suggest that maybe we have another decent year in 2025, right?
Yeah, look, I mean, like, humans seem to, like, I think people are generally mean reverting in their head. Like, they sort of think about things like, if it goes up, it's got to go down. Sort of like, that's just sort of like built into our brains somehow. I don't know why that is, but it does seem to be the case. The problem with being a mean reverting person is the market is a trending system. And so, like, the market does not mean revert. Otherwise, we'd still be trading the same levels we were trading at in 1932, which we're not. And so this chart is just one way to look at it. Is like, hey, you just had a great year. You had a plus, an over 20% year. Well, like, what's next year look like, at least historically? Next year looks like it's pretty good. Like a pretty averagey, like mid, kind of low to mid teens kind of year, like, should be sort of the unconditional expectation. The only point here is, like, just because you had a good year this year doesn't mean you have a bad year next year. Like, don't make that mistake. Please don't make that mistake, because it's just wrong. And next chart will, next page will say the same thing.
Yeah, I think that's extremely important, Scott, is you talk about this idea of, is the market mean reverting? Well, again, chart on the right, chart on the left, they both tell you that no, it's not, right? What happens after you hit an all-time high? Generally speaking, you're going to hit another all-time high shortly thereafter. That's the chart on the left, and it shows you just kind of the number of all-time highs that we continue to hit day after day, month after month, year after year. The chart on the right, though, actually kind of spells it out into actual kind of return-based data. And what it looks at is the gray bar says, hey, if you were to put money to work on any average market day, right? That's what should you expect 3 months forward, 6 months forward, a year, 2, 3, 5 on a go-forward basis. The green bars in that same chart say, if I only invested that new money on all-time high days, again, that speaks exactly, Scott, to what you just said, is because the market is trending, because it is not mean reverting, actually what you see is when you invest on those all-time high days, as you get 1 year out, 2 years out, 3 years, 5 years, the total cumulative return that you would expect historically, it's actually higher than that average day had you invested on that average day. And I think, again, that doesn't necessarily sit well with people's heads because of that mean reverting phenomenon, but it's extremely important to understand. So we wanted to leave you with that. But the last thing, and Scott, I mean, I think we have to talk about it, is, okay, we saw what happened in 2017 following the surprise election of President Trump there in the 2016 election. Here are a few things that were kind of consensus forecasts as we headed into 2017. So let's talk about that now, and then we're going to look at, okay, how did that actually play out? Because I think it's important for folks to remember maybe the difference between what we thought was going to happen and maybe what actually did.
Yeah, and to be clear, so let me tell you what you're looking at here. This is what I did. This isn't what Horizon Investments necessarily thought, but what I did is I used AI and said, hey, listen, go pull me all, like give me all the research you can find in terms of, like, what were people saying at the end of 2016? Like, what was JP Morgan or Goldman or, like, Newberg, like, whoever, like, all the different sort of investment folks, like, what was everybody saying at the end of 2016 about where you should invest in 2017, in year one of Trump won? And it was basically like this. It was like, you got to be in U.S. stocks. They're gonna trounce internationals, and if you touch an emerging market stock, you got to be the dumbest thing this size sliced bread. There's no reason for you to touch an emerging market stock, especially China, because Trump's going to crush them. And so, like, why would you do such a silly thing? And the dollar's gonna scream. It's gonna be really, really strong. So, like, just stay in the U.S. and you'll be fine. Like, you need to invest anywhere else. So that's what everybody thought coming into year one of Trump won. What we got was not that, unsurprisingly. What we got is international stocks actually outperformed U.S. stocks during year one of Trump 1. Even though like it was a very consensus thing to say that U.S. stocks were going to dominate, especially in that first year. And not only, and by the way, this is in the backdrop of the dollar also went down. So like basically everything that everybody thought for coming in at year one Trump 1 was wrong. And international stocks outperformed. And if you go to look at emerging market stocks, they creamed the S&P 500. And so like again, just like please don't like we have to remember like I'm not and this is not hearing me telling you that emerging market stocks and international are going to cream the S&P next year. But this is me saying everybody's pretty darn sure last time. And it seemed like everybody's pretty darn sure this time that U.S. stocks is the only place to be, and you need to invest anywhere else. And it was not the case last time. Now this is a very different fact pattern, the world's a different place, all that stuff. But at the same time, like let's just at least remember this and be cognizant of it as we think through how we're investing this year. This is something that we're taking account of as we think through investments. We're still overweight U.S. Like at Horizon, but it is something that we're very, very cognizant about. Like it was such a consensus trade. Year one Trump 1 last time is a very consensus trade right now. It's got us uncomfortable. But it's still something that we think makes sense. But I'd be lying to you if I say we're probably just gonna set it and forget it this year. This is something that we're like really hyper focused on because it was so wrong last time and equally as obvious last time too.
No, that's a great point, Scott. And there's really no better way in my mind to end a deck than with the Kimbe Mutombo giving you the finger wag. So that being said, we got a few takeaways here on kind of this last slide. We do have a couple questions that we'll make sure to hit on. But remember what we talked about today, right? We talked about the fact that folks are actually starting to get optimistic again from a company standpoint. How does that impact small companies, large companies? We talked about that. Talked about the consumer again. I think that's important to understand. And then we talked about kind of some of the uncertainty that's been kind of come to the surface over the last month or so, but how that jives with the fundamentals and what should we expect? Maybe what we believe we should expect isn't necessarily the case either. So I think those are all important takeaways, hopefully, that you leave today with. Scott, a couple questions have come in, and I can kind of group them into one. Is, hey, we didn't talk a lot about fixed income explicitly, right? We talked about rates, we talked about inflation, but what's our outlook on kind of the fixed income markets more broadly as we head into 2025 and beyond? Is that an area of the market that we should be diving back into? Is that an area we should be overweighting? What does that look like as you head out into the next 6, 9, 12 months?
Look, it's probably fine. Fixed income markets will probably be fine. This is not a 2022. We're not going to go from a 0% rate to a 5% rate and get clobbered. But at the same time, we don't think rates are going to fall precipitously from here either because obviously we don't see a recession coming still. And so like rates, like fixed income probably expect 4 or 5% nominal return, make it 2% or so real return for investment grade U.S. portfolio. Like it's it's in the neighborhood, right? Should be okay. It's just like you just see much better in stocks. Like over the last 5 years, for instance, the ag is down 3% cumulatively. The S&P is up 100% cumulatively. So it's like we don't think it's gonna be that stark, but it's not this is not the place nor the time we think to get super overweight bonds. The only time that works, frankly, is when stock markets get creamed and get creamed in a deflationary type of environment, not an inflationary environment like 2022. So if you think stocks are gonna get creamed because we're gonna get a recession, then yeah, overweight. Then yes, so they're the right ways to be overweight bonds. If you don't think that, then it is never right to be overweight bonds ever. So that's just reality. So that's we think fixed income is gonna be okay. But not certainly not a place to be overweight right now.
And Scott, you actually touched on the other question that had come up a little bit over the last hour or so that we've been together, is this idea of a recession. I think it's hopefully pretty obvious at this point. We actually think the underlying kind of data, the underlying information that we're seeing would suggest that really a recessionary environment isn't at the forefront of what we would expect in 2025. Obviously, and Scott, you mentioned a lot can change. There can be some unknowns that maybe we don't see at this point. But Scott, would it be fair to say that we really don't see a recession in the cards anytime soon, given everything that we just talked about?
No, look, I mean, at the end of the day, we talked a lot about the resilience of the, of the consumer. Like look, to be clear, like getting the consumer right is like most of the battle. And when if you're talking about a recession, I mean, like outside of like major fiscal imbalances or major leverage problems like you had in 08, like getting if you get the consumer part right, you generally get the economy part right. And again, this is a consumer that has a lot of sort of robustness built inside of it in terms of some of the safety that they've got in assets. Job market is still pretty darn strong, and I'm not saying the world is a completely safe place, but there's certainly good things that could happen. But endogenous to the system, the things that we can look at right now and see and understand, we don't see a sort of an outsized risk of a recession sometime during 2025.
Awesome. Good stuff, Scott. Really appreciate the time and appreciate the insight that our team kind of brings to the table and the ability to unpack that as part of today's time together. I would tell you, for anybody that maybe has additional questions, please don't hesitate to reach out to our team, whether that's a strategist or an analyst that you're working with, whether that's a regional director or an internal that you're working with. We'd be happy to continue the conversation. We'd love to take it a step further. We'd love to kind of have, more in-depth conversation around stuff that's relevant to you and your individual clients that you may be running into. Love to have those conversations. I would stress the importance of, hey, don't hesitate. And please go check out our website. That's where we post a lot of content on a regular basis, multiple times a week. You'll see that. For those of you that are using our technology tools, you'll see that information there. We would encourage, if you're not familiar with our technology tools, please reach out. We'd be happy to get that set up. You have the ability to run proposals. You have the ability to get a lot of the information that we're looking at from a team standpoint, and information on our strategies as well, which hopefully will be helpful as you're having those conversations within clients. So without anything further, we will wrap up today, and we look forward to talking to a number of you as we head into 2025. Really appreciate the time this afternoon and hope to see many of you soon. Thanks so much.